Today, we're diving into the exciting world of valuation models, a critical tool in finance. These models help us understand the true economic worth of various assets and entire businesses. Let's begin with a cornerstone: the discounted cash flow, or DCF, valuation method. DCF is a fundamental technique to determine intrinsic value by estimating the present value of future cash flows, considering risk. Now, let's explore the core elements that make up a discounted cash flow, or DCF valuation. These are the essential building blocks we use to calculate a company's intrinsic value. First, we have free cash flow, a crucial metric in our valuation analysis. This is the actual cash left for investors after all operational expenses have been paid. Next, we consider the discount rate, which is vital for bringing future values to the present. It's the rate used to convert those future cash flows into their equivalent present value. Then, we calculate the terminal value, which accounts for the business's worth in perpetuity. This estimates the business value beyond our explicit forecast period, assuming continued operations. Finally, we establish the time horizon, defining our projection window. This is the specific period, typically 5 to 10 years, for projecting detailed cash flows. Let's walk through the 4 essential steps involved in a discounted cash flow, or DCF valuation. We'll cover the journey from initial forecasting all the way to determining the final enterprise value. The first step is to forecast the free cash flow, or FCF, for future periods. We project these future cash flows based on historical growth patterns and detailed assumptions. Next, we determine the appropriate discount rate to use for our valuation. This involves calculating the weighted average cost of capital, or WACC, or the cost of equity. Our third step is to calculate the terminal value, or TV, of the business. We estimate the value beyond the explicit projection period, often using models like Gordon growth. Finally, we discount all these future values back to their present worth. This brings all future cash flows and the terminal value to their current present value. Now, let's explore 2 key metrics: net present value and internal rate of return. These powerful tools are essential for evaluating the financial viability of any project or investment. First, let's discuss net present value, commonly known as NPV. NPV is the sum of the present values of all cash inflows and outflows of a project. Generally, projects with an NPV greater than 0 are considered acceptable investments. A key advantage of NPV is that it fully accounts for the time value of money. Next, we have the internal rate of return, or IRR, another important metric. IRR is the discount rate that makes the net present value of a project exactly 0. We typically accept projects where the IRR is greater than our required rate of return. Essentially, IRR represents a project's break-even rate of return, a useful benchmark. Now, let's compare net present value, or NPV, with the internal rate of return, or IRR. This comparison will help us understand when to choose the right investment metric. We will evaluate these metrics based on several important factors. Let's start by looking at their fundamental definitions. Then, we'll examine the decision rules for each. We'll also discuss when each metric is best used in practice. And finally, whether each metric considers debt in its calculation. Let's start by examining the details for net present value, or NPV. NPV represents the total value created by a project in present terms. The decision rule for NPV is to accept a project if its NPV is greater than 0. NPV is best used when comparing projects with different scales or cash flow patterns. Yes, NPV does indeed consider the cost of debt in its calculation. Now, let's move on to the internal rate of return, or IRR. IRR is defined as the discount rate where the net present value equals 0. The decision rule for IRR is to accept if the IRR is greater than the WACC. IRR is best used when you want to find a project's break-even return rate. No, IRR typically does not explicitly consider debt in its calculation process. Let's dive into the price-to-earnings, or P/E, ratio, a fundamental metric for evaluating a company's stock. This ratio compares stock price to earnings per share, showing what investors pay for each rupee of earnings, crucial for public stock valuation. Next, we'll explore the enterprise value to EBITDA, or EV to EBITDA, ratio, another powerful valuation tool. This ratio assesses total valuation against earnings before interest, taxes, depreciation, and amortization, vital for mergers and acquisitions. Now, let's explore the three core valuation approaches, each offering a distinct perspective on asset value. These approaches act as different lenses, helping us accurately value a variety of assets and businesses. First, we have the cost approach, which focuses on determining value based on the cost to replace an asset. This method determines value by calculating what it would cost to reproduce or replace the asset today. It's primarily used for tangible assets such as real estate and specialized machinery, where replacement cost is clear. Next, let's consider the market approach, which relies heavily on observable market data for valuation. This approach compares the asset or company being valued to recent sales of similar assets or companies. It's widely applied in stock market valuation and for valuing companies in mergers and acquisitions. Finally, we have the income approach, which focuses on future economic benefits. This method values an asset or business based on the income it is expected to generate in the future. It's a cornerstone for business valuation, especially in private equity deals, estimating future cash flows. Let's compare how we value startups versus established companies, as their characteristics differ greatly. We must tailor our valuation methods to account for their unique growth trajectories and risk profiles. First, let's look at startup valuation, which presents unique challenges due to their early stage. Startups often have low or negative earnings and face high uncertainty, making traditional metrics difficult. They typically have high, yet uncertain, growth potential, which is a key factor in their valuation. Entering new markets means high risk, requiring different valuation considerations compared to mature firms. Therefore, we use revenue multiples and the venture capital method to value these early-stage businesses. Now, let's turn our attention to the valuation of established companies, which have a proven track record. Established companies typically exhibit stable, consistent earnings and a clear path to profitability. Their growth is generally moderate and more predictable, allowing for traditional forecasting methods. With a proven business model, they carry lower risk, making their future performance easier to assess. For these firms, we commonly use metrics like the P/E ratio, EV/EBITDA, and discounted cash flow. Let's quickly recap the key takeaways from our discussion on corporate financial strategy and valuation. Here are the most important points you should remember from this comprehensive lecture on valuation. Remember, discounted cash flow, or DCF, estimates intrinsic value by discounting a company's future cash flows. Net present value measures absolute profitability, while internal rate of return shows a project's break-even return. The P/E ratio and EV/EBITDA are crucial market-based tools for conducting relative valuation of companies. Our core valuation approaches are the cost, market, and income methods, each with distinct applications. Startups use revenue multiples because they lack profits, while established firms rely on earnings-based metrics. Future trends in valuation include advanced AI-driven models and important ESG-based adjustments for sustainability.